Thank you very much, everyone, for attending. Let's get started, and welcome to this webinar on the role of intercompany agreements in attracting capital to international SME groups. My name is Paul Sutton, and just to give a little bit of background, I'm one of the co-founders of LCN. I'm a corporate lawyer by background, but one of the things that we specialize in at LCN is the legal implementation of transfer pricing and the design and legal implementation of cross-border structures. So this is something that I first got exposed to when I joined KPMG's law firm back in 2001, and is something that I have focused on ever since, and is really our core area of expertise within LCN. So what we're going to talk about today is the role of intercompany agreements. So what are they? Why they're an essential part of preparing a group to attract capital, so significant fundraising projects or for sale. We're going to talk about the overriding requirement for intercompany transactions to be commercially rational, so to make sense, and how intercompany agreements support compliance, control, and strategic goals. And we're going to talk about practical steps that CFOs can take to improve audit readiness and due diligence readiness. In fact, it's not just CFOs, but also finance directors, founders, and in-house legal counsel. So just a couple of housekeeping things. We will share the slides following this webinar, so you don't need to worry about that. If you do have any questions, then please use the chat function, and I'll do my best to get to them at the end of this presentation. So let's talk about what intercompany agreements are and why they matter. So if you imagine a corporate group, let's say it has a US parent entity and various operating subsidiaries in other countries. So intercompany agreements are legal agreements, so they're proper legally binding agreements which document the terms of transactions between those group entities. And the transactions that we might be talking about, it could be simply appointing a limited function distributor in a particular country. It could be that there is an R&D team which is engaged in developing or maintaining software, for example. It could be other support functions such as sales and marketing support, but it can also include loans and cash pooling arrangements. So it's legal agreements that covers the whole range of intercompany transaction types between the group. The reason why they matter is that those agreements in place within your group effectively provide the backbone or the central source of truth for internal accountability and external compliance. In other words, they describe and document the terms and the nature of those intercompany transactions. And this central source of truth is critical for a number of different stakeholders, and we'll come on to that in a little bit. They're also the building block for transfer pricing compliance and for transactional comparability. So for those of you who are not familiar with transfer pricing is essentially the international set of rules which dictates, in effect, where profits of a group are taxed, in other words, in which country. And the core principle behind transfer pricing is the arm's length principle. In other words, even though members of a group comprise related parties, so there is control in the form of common shareholdings, the fundamental principle is that the individual transaction should be designed on a commercially rational basis and priced on an arm's length basis. And that is the fundamental principle of transfer pricing. And that's part of the patchwork of tax and regulatory compliance obligations that a group is needing to work with. And intercompany agreements are also a key tool for controlling other tax risks across borders. So this includes things like withholding taxes, corporation tax deductibility, and also the VAT treatments of transactions. So that's what we're talking about here. So this slide is about how are things different now in 2025 compared to maybe the environment 5 years ago or even 20 years ago. And I'm just going to give a high-level rundown of how the environment has moved on, and maybe some of the ideas and preconceptions about what the challenge is may not be accurate anymore. So obviously one factor is we've got the growing complexity of international operations amongst multinational enterprises and international SMEs. In other words, the general trend is that businesses are more international, there's more cross-border transactions, it's actually easier to set up businesses in different locations, and groups both large and medium-sized, are taking advantage of that flexibility, which is a good thing. So a lot of the clients that we look after here at LCN are large corporates, so they're above the 750 million euros revenue threshold. That means that they are subject to a high level of compliance burden as regards transfer pricing. But a lot of the groups that we support are maybe in the category of micro multinational. So maybe they've only got operations in 2 or 3 countries, but nevertheless, they need to structure those operations in a sensible way. Another factor in terms of the landscape is the role of intangible assets or intellectual property. And there have been various estimates, and one of the most recent studies is by Ocean Tomu. And at that time, I think that was a couple of years ago, this was the estimate that the value of intangibles or intellectual property actually accounts for 90% of the market value of the S&P 500. And it's important to remember that when we talk about intangibles, it's not just registered trademarks, it's not just brands, it's not just copyright. It's also softer intangibles. So when you think about a brand or a business such as Starbucks, yes, the trademark is extremely important, but there's a huge amount of operational know-how, for example, how to set up a new coffee shop and how to manage it on a day-to-day basis, how to manage suppliers, employees, and so on. And that's operational know-how is actually a very valuable intangible because it enables a business to operate at scale, or if it's at the growth stage, it actually enables that business to scale up. And the need to properly account for that and price cross-border transactions involving those intangibles is a key contribution that the finance, tax, legal team makes to the value of the group concerned. The next key factor is really the reset, the global reset of tax governance standards across the board. So whereas maybe 10 years ago or 20 years ago, it may have been sufficient to go to an advisory firm and ask them to produce a transfer pricing study, and that was often produced after the event. So for a particular financial year, it would have been a look back report, and that would have been the extent of transfer pricing compliance. Now, the challenge is that intercompany transactions must be designed in advance, must be implemented in advance, and must be commercially rational. So if you look at, for example, the OECD transfer pricing guidelines, the latest version was issued in 2022. That starting point of commercial rationality is actually the cornerstone of transfer pricing. And if you also look at guidance issued in countries such as Germany and UK, the recurring theme is the need for commercial rationality and contemporaneous documentation, which means not just after the event, it means designed in advance. The next key feature is obviously heightened tax authority scrutiny. One way of looking at it is that in relation to the transfer pricing challenge, every individual tax authority, every country wants a slice of the pie. In other words, wants to be able to tax a suitable slice of the group profits. And one easy win is to bring transfer pricing challenges. In other words, to challenge the pricing of related party transactions and to make whatever arguments most benefit that tax authority. So that may be based on intangibles, in that a local contribution to intangibles is not properly being rewarded, or it may be at the other end of the transaction, it may be management services or support fees, in saying that the payer of the relevant cross-border charges is not actually getting a benefit from that transaction. So this is part of the battleground as between tax authorities, who gets to tax the profits. And it means that international SMEs and multinational groups are really in the middle of that battle and are needing to protect themselves in a sensible way. So that's what we're talking about here. A related feature of the landscape is the growing requirements or the growing risk that corporation tax deductions will be denied if they're not supported by intercompany agreements. So if you look at recent cases such as Aspro in the in the US, this related to a US group which over a period of years had been paying management charges or so-called management charges to related parties and had been claiming a tax deduction in the US. The issue was that the group had failed to document the nature of those payments, had no agreements to support the nature of those payments and the fact that they were in the nature of payment for services as opposed to dividends, for example. And the result was that those corporation tax deductions in the US are denied or were denied in that particular case. And there's a growing number of tax jurisdictions, including perhaps Germany and Mexico and so on, where they will routinely deny those corporate tax deductions where they're not supported by contemporaneous agreements. A related part of the complexity and challenge right now is obviously the tariffs and customs environment, which has been extremely volatile, to say the least, this year. But when you think about cross-border transactions involving goods, it means that there is a risk of non-compliance if the transaction is not properly documented, but also there's a risk of failing to structure a transaction in the optimal way by not looking at it in advance. So this is part of the environment here. A related issue is the expectations of shareholders and institutional investors and the low tolerance of bad news. So if you look at the Amgen case, this was a case of a company which had allegedly failed to disclose to the market certain tax liabilities, which were actually arising from transfer pricing. And so what the company faced is not just the tax liability as a balance sheet issue and a liability issue. Actually, at the investor level, it is still facing claims by investors that the failure to disclose those liabilities that the company should have been aware of is an additional ground for liability. In other words, it's an abuse of the market. It's a failure to comply with the group's disclosure obligations on an ongoing basis. And then the final thing is that unfortunately backdating agreements, backdating intercompany pricing just doesn't work. If you look at the classic case, which is probably Coca-Cola, so this is a 2020 decision of the US tax court, which actually related back to the period 2007, 2009. So from a high level perspective, what happened there was that during that period, Coca-Cola was applying a particular transfer pricing policy in terms of the relationship between the US entities and these local supply points in different countries like Luxembourg and Ireland and so on. The problem was that the agreements that Coca-Cola had in that period totally contradicted its tax position. And what the US tax court said was, sorry guys, it's a one-way street here. You as the taxpayer, you had complete freedom and flexibility as to how you designed and documented your intercompany transactions and your intercompany agreements. You don't get to disavow your agreements after the event. You don't get to bring economic arguments as to why the IRS should actually ignore those agreements. It's only the IRS that gets to bring those kind of economic arguments. In other words, effectively, once you've put your agreement in place, you can't bring conduct or economic arguments to overturn. And when you combine that with the fact that backdating intercompany agreements does not work, is unlikely to be effective, it means that you actually do need to make a choice and you need to do your best to get that right. So I've talked quite a lot about tax and transfer pricing in relation to the previous slide. Just really like to zoom out and look at a holistic perspective in terms of the benefits of having audit-ready intercompany agreements. And when I say audit-ready, it means partly in terms of tax audits, transfer pricing audits. In other words, when the inspection comes, do you have the right bundle of documents in the right place so that you can easily and quickly disclose, here's the analysis, here's how we price the transactions, here are the agreements that support this, here's the evidence that brings it all together. So that's what we mean by tax audit ready, but also we're talking about auditors in the context of statutory accounts, but also from a transactional perspective, we're talking about due diligence ready. In other words, if you're on a fundraising round or if you're preparing your company for exit, you want to make sure before you go into that process that you've actually got your story straight and your documentation straight. So let's go through this slide from the top. So point number one is entity level accounting. And when you think about it, it's obvious that where there are material intercompany transactions between any given entities within the group, those intercompany transactions are going to affect the financial statements of each individual entity which is a party to those transactions. So put it another way, unless you're clear about how those transactions are defined, it's almost impossible to finalize or to be confident about how you can finalize your legal entity statutory accounts because you don't have a clear reference point. So it supports the reconciliation of balances and it facilitates clean audit. That's point number one, or factor number one. Factor number two is, as we mentioned before, corporation tax compliance. So it documents the basis for deductible expenses and charges from the paying entity's perspective. And in relation to our work at LCM, we've come across various situations where clients have come to us because they've had an issue in terms of previous denial of corporation tax deductions, and they want to make sure that they're in the right place going forward. Factor number three is what we've been talking about from a transfer pricing compliance. So agreements are actually the building block for commercial rationality because they actually define what is the commercial transaction between the relevant parties. So if you think of a situation, say a US headquartered group, maybe it has a distributor in Germany, the agreement will actually document what is the arrangement between those two entities. What are the risks borne by the German entity? Does it bear product liability risks? Does it bear compliance risks? Does it actually bear the market risk of reduction in demand in that particular product? Because the answer to those questions in terms of who bears which risk is going to be an important input for how that transaction is priced. So it's the building block for defining and expressing a commercially rational transaction. The agreement also dictates the terms as regards IP ownership, and therefore it's core to how you actually manage the intellectual property within the group. And when we think back to the fact that for many groups, actually IP accounts for 90% of the value, being clear about where the IP rights actually sit is really the starting point. It's the ticket to play for that group to be able to manage its IP rights effectively. And of course, in terms of putting in place audit-ready agreements, it means that you're aligning the group with the requirements of OECD guidelines and with the requirements for local transfer pricing documentation. Moving on to item 4 here, so regulatory compliance. So this applies both for traditionally regulated groups such as banks, financial institutions, fintech companies, but it also applies for normal, if you like, trading companies which are not subject to additional regulatory regimes. So for regulated groups, if you imagine, for example, a fintech group which has entities which are regulated in different countries from a financial services perspective, and let's say there's a UK regulated entity, and let's say that UK regulated entity actually receives services from related parties within the group. So that might be IT support or back office support. If you think about that transaction from the perspective of the UK financial services regulator, so the FCA, even though the transaction is intergroup, that will be regarded as a potentially material outsourcing arrangement. And therefore, the UK regulator, the FCA, is going to expect to see the same kind of protections in that related party agreement as would be in an outsourcing agreement with a third party. And of course, where your group is regulated, then regulatory compliance is the ticket to play, because without that, you don't have a business at all. And therefore, as part of the regulatory compliance, you're going to need to get your agreements right. But looking at the second bullet, they're reducing personal liability risks for directors. This applies even for non-regulated groups. So probably the clearest way of expressing that is, so even though for many reporting purposes, you're looking at a consolidated position for the group in terms of revenue and profit and loss and so on, you're still dealing with individual legal entities in individual countries. Each of those legal entities has its own directors, which are subject to personal fiduciary duties. And those personal fiduciary duties generally include the obligation to have regard to the interests of the employees of that entity and the creditors of that entity. And so what that means is that if the group were to be subject to insolvency risks, then those directors need to be able to demonstrate that the terms of related party transactions are actually on arm's length terms, are commercially rational, because if they're not, then the directors may be subject to personal liabilities and personal sanctions. So point 5, tariffs, withholding taxes, and VAT. We've touched on this already. So just to give another example, imagine that you had a situation with transactions between a US entity and a sister entity in Canada. Those transactions may include royalties for trademarks, royalties for software, maybe management support services. Those fees between the related entities may be subject to different withholding taxes depending on the nature of the individual payment. So is it a payment for services? Is it a royalty? And if so, what is it a royalty for? And again, in terms of the transaction design and proactively managing the group's withholding taxes compliance, the agreement between the related parties, so here it's between US and Canada, is a key way of defining the transaction. So it's the cornerstone for then analyzing and making sure that you're complying from a withholding tax and VAT and tariffs perspectives. And then the final point 6 on this slide is about investor readiness, funder readiness, and exit readiness. So having a clear handle on your intercompany transactions, and in particular intangibles, intellectual property, it demonstrates that you have a handle on the enforceability of IP. Where does it sit? Which entity would actually be suing if there were an infringement situation? Demonstrates the proper level of governance control, and ultimately it reduces unnecessary due diligence risks and price chips when it comes to achieving the highest exit value. So one of the other changes in the transfer pricing world over the last couple of years is the growth of transfer pricing insurance as an ability to manage those risks. But the fact that you may be able to insure against transfer pricing risks, it doesn't mean that you can therefore ignore the issue, because the cost of that insurance is going to depend on how robust your underlying position is. So having your agreements in place and having done that internal homework in terms of how you scope out the IP, how you protect that IP, where it's held by which entity, it's a key part of enhancing the exit value or the investment value of the group as a whole. So I'm going to move on and talk about some of the common pitfalls here that we see when we start working with multinational enterprises and international SMEs for the first time. So the first one is no clear chain of title for IP. So for those who are not familiar with the concept of chain of title, it means your ability to track through the current owner of intellectual property, for example, software, and trace how the entity that you're saying owns it right now acquired those rights. So were there other entities in the group that contributed to the creation or development of that IP? Were there third parties involved? Were there founders involved? So in other words, it's a key thing in terms of maximizing investor value, enterprise value, to be able to track through that chain of title. And as I've already mentioned, it's a common pitfall that groups actually have lack of clarity as to how intangible assets are held and protected. And that's because they get stuck on the consolidated group-wide view without actually realizing that legal rights are only enforceable on a jurisdiction-by-jurisdiction basis, on an entity-by-entity basis. So you really do need to have a clear handle on that. Another common thing is intercompany agreements being missing or outdated or unmanageable. And so we have the recent example of Coca-Cola, which did have agreements in place during the relevant period, but they were totally outdated. Many of them were missing. Actually, none of them had pricing clauses that aligned with how the group was actually operating in terms of its transfer pricing policies. We also come across a lot of groups which have unnecessarily complicated intercompany agreements. So in some cases, agreements which are 40, 50, 60, or even more pages long, totally unfit for service, what's for purpose, more agreements than are needed, no standard approach to intercompany agreements. So they're making their lives already a lot more difficult than they need to be, and they're creating totally unnecessary risks. No coherent explanation of intercompany transaction flows. So what we're looking for here, both from an agreement perspective and from a transfer pricing perspective, is to have a clear breakdown of what are the intercompany transaction types. So that you may have central support services, you may have licensing of IP, you may have R&D support services, you may have appointment of distributors. So it's having a clear matrix of intercompany transactions to explain who does what for whom, what is the nature of those transactions, and how are they priced? And we'll come on to that, I think, in the next slide when we talk about the matrix. Misalignment between operations and documentation. So obviously, there's no point in having a tax strategy or a transfer pricing policy document if it doesn't align with how the group actually works. Similarly, there's no point in having agreements if they are contradicted by the way that the group actually works. So we need to have that alignment between the reality, the tax policies, transfer pricing policies, and the actual agreements. A related point is misalignment in how the same transaction is described to different tax authorities. So if you imagine the simplest transaction where you may have a service provision from one entity in one country to another entity in another country, obviously, there can only be one transaction, and clear way of creating unnecessary risk is for your tax returns, for your entity accounts to describe the transaction in different ways at both ends and to price it at different ways at both ends, because it's really an easy win for a regulator or an auditor or a tax authority to question that. And all of those pitfalls leads to delayed responses to tax authority inquiries, which creates unnecessary risk of adverse tax assessments and also unnecessary costs and management time in trying to firefight after the event. And similarly, gaps in audit trail and inconsistencies in filings. In other words, the overall objective that we're trying to address here is let's simplify our intercompany transaction flows. Let's make them commercially manageable, and let's document them in a clear and commercially rational way. So building on that, what are we actually trying to achieve, or what are the standards that we're trying to achieve in building a fit-for-purpose portfolio of ICAs or intercompany agreements? So if you look at the left-hand side, what are the requirements for each individual agreement? So number one, it needs to be legally binding. It needs to be a genuine agreement that is capable of being legally binding. It needs to be signed and dated, and there are various tax authorities that apply a rigorous test in, as I mentioned before, in saying if an agreement is not signed and dated, then the relevant tax deduction for the relevant payment is going to be denied. Third point is the agreements do need to be clear and unambiguous. So in the past, there has been this idea of, well, let's just keep the agreements vague and ambiguous, because if it's vague, then it will never be wrong. Unfortunately, the standard is clear and unambiguous. This aligns with the arm's length principle. This aligns with the guidance issued by various tax authorities, including the US, Germany, UK, and so on. So that's what we need to have here. It needs to be aligned with the transfer pricing analysis. So for those not familiar with FAR, so for FAR analysis, that stands for functions, assets, and risks. So part of the cornerstone in assessing the arm's length nature of a transaction is to look at functions. So who does what, which entity contributes what to the value chain. Assets, which entity contributes what assets to the transaction as well. And then in relation to risk, which entities contribute to the control of risks and which entities actually assume those risks from a contractual perspective. So clearly, there's going to be very little value in having transfer pricing documentation if it's contradicted by the agreements actually in place or not supported by appropriate agreements in place. The agreements need to maintain the enforceability of intellectual property. In other words, for many groups, at a certain scale, they will have an IP protection and enforcement strategy. It may be documented at different levels of formality, but in any event, the IP team, whether it's in-house or outsourced, will need to be clear on where IP rights sit and therefore what needs to happen in order to defend and enforce IP. And the agreements need to contribute to that effort as opposed to undermining it by contradicting the IP protection strategy. The agreements need to meet the needs of wider stakeholders. So this is what we've been through earlier. So that includes withholding taxes, VAT, statutory accounts, and so on. The agreements need to be localized as needed. So for some intercompany transaction types and for some countries, that means that the transaction needs to be very bespoke. For example, a lot of our clients have operations in China. China tax authorities very often have a different view of transactions, and therefore, from a risk mitigation perspective, the transactions need to be specifically adapted for the China entities and documented accordingly. For other transactions, the localization may be just in the markup percentage. So, for example, if you have an R&D service provider entity in India, the markup for recharging the costs of that team may be higher. It may be like 17%, 20%, as opposed to the markup, which may be acceptable in other countries, such as Germany, UK, US, and so on. And as mentioned before, they need to be contemporaneous as much as possible. In other words, entered into in advance. One thing to mention when we're talking about these requirements and the different stakeholders is what we're not advocating is gold plating everything. So a key task really for a group, for a CFO, for a head of tax, head of transfer pricing, general counsel, whoever is assuming responsibility for the project, is to assess, okay, what are we up against here? What are the transactions? What are the risks? What are the stakeholders? And then apply a proportionate level of effort and due diligence in terms of meeting the needs of those stakeholders. So we're looking to achieve a balance here in terms of standardization versus localization and so on. So when we look at the right-hand sides here, the starting point is the transactions matrix that I was mentioning before. So that means analyzing, if you haven't done it already, what are the key transaction types for the relevant financial year in question that you're dealing with. Often in the groups that we work with, they may be just like 3, 4, 5 key transaction types, such as appointment of limited function distributors, IP licenses, support services, intercompany loan transactions. So it's getting clear on one of those transactions are, getting clear on one of the legal entities, including branches, are participating in those transactions, and that information, so the matrix of transactions and the entities are translated into probably a master agreement covering those individual transaction types. So you would have ICA 1 covering transaction type 1, which may be central support services, ICA 2 covering intercompany distribution functions. And as I mentioned before, one of the things that really makes a difference in making your life easier is standardizing those transactions as much as possible. So I'm going to give a real life example here. So imagine that you're dealing with a group and you are looking after entity A, and let's say it's a SaaS group established in the US, which sells SaaS product A. And let's say what's happening is that you're about to acquire a subsidiary in a different country, let's say Germany, entity B, and entity B has its own SaaS technology. And so that will be associated with, it will have its own management team, it will probably have its own R&D function, and it will own certain intellectual property. It will be entering into contracts with third parties, and it will be carrying on that ongoing R&D activity. So in that scenario, what you need to do is make a decision in real time. What are you going to do with the functions carried on by entity B? What are you going to do with the IP owned by entity B? And how is it going to be integrated into the newly merged group? And from a high-level perspective, when you think about the choices as regards IP, you have 3 main options. So one is that you could leave entity B IP where it is, so it continues to be owned by entity B. And that means that to the extent that A is integrating that IP into its suite of products, probably means that A is going to be paying some form of royalty going forward to B as the IP owner. So that's one option, is just leave it where it is and put in place intercompany royalty agreement, some form of agreement like. Option 2 might be to transfer that IP. So that might be an intercompany IP sale agreement between B as the seller and A as the buyer. That may be attractive from an operational perspective because it will centralize that IP and it may make it easier to manage it going forward. There may be a downside in terms of tax charges, so exit charges going forward. So this is something that you'll want to look at. Option number 3 might be some form of IP. So one way of structuring this is what's called a wither on the vine strategy. So you leave the entity B IP where it is in terms of the value as at day one of the merger, but you put in place appropriate arrangements so that the future enhancements of that IP is actually owned by entity A. And that would mean that to the extent that B still has an R&D team, that on the costs of that R&D team are going to be recharged to A going forward. So there's an intercompany transaction there. And it may be that the value of the legacy B IP declines over time. So there is an intercompany IP license, but maybe the royalty reduces over time. So the point of that mini scenario here is to say that this is the kind of scenario that groups are dealing with on a day-to-day basis. And unfortunately, it's a decision that needs to be made in real time, because you can't go back 3 years and say, well, actually, we'd have liked to have sold or transferred the product B IP and transferred it up to A. You can't rewrite history there. So you need to address the situation as it is and make your choices based on your assessment of the different stakeholders involved and choosing the best route in your view at the time. So I'm going to come on and talk about possible next steps for CFOs, tax teams, in-house legal counsel. I can see that there's a question in the Q&A, so thank you for that. Some TP advisors claim that TP agreements are actually optional if TP analysis documentation is intact. What's your take on this? It's a really great question. I would say that the position has changed massively over the last 5 years, 10 years. So whereas before, yes, possibly that was the prevailing view amongst some transfer pricing advisors, it's definitely no longer a safe position going forward. And that is because the compliance environment has changed massively. So for example, if you look at the guidance issued by HMRC in the UK, so this was September last year, it was talking about the governance and control framework for transfer pricing compliance. It was emphasizing the fact that agreements, transactions need to be designed in advance, need to be implemented in advance, managed in real time, and then reported on accurately after the event. Part of the HMRC guidance is also that contractual allocation of risk can have independent value irrespective of functions. And there's actually an example of that in the OECD transfer pricing guidelines, which is about inventory risk. So inventory risk is the risk that a distributor may maintain stocks of products and may be unable to sell them, or those stocks may be obsolete. And so inventory risk can be an economically significant risk. And the OECD TP guidelines actually gives an example of the difference that a buyback clause, like either having it or not having it, makes on the economics of the analysis. And in that example, it actually makes a 20% difference in the pricing of the transaction. So a buyback clause is the principal saying to the distributor, hey, please buy and maintain stocks of our products, but don't worry if you can't sell it, because we'll buy back buy back the stock at cost. So that's one way of documenting the fact that the inventory risk has actually been assumed by the principal as opposed to it remaining with the distributor. So contractual terms do actually change the economic nature of a transaction. You can't merely rely on functional analysis, and you certainly can't rely on transfer pricing reports that are prepared after the event. So unfortunately, that's no longer a safe position to rely on. So let's just go through from the top. Next steps, if you're looking after the group and if you're aware that your agreements are maybe out of date, they were last looked at 5 years ago, or where maybe you've got no agreements at all, or you're aware of gaps. So the starting point is actually to create the clear matrix of intercompany transactions as for the financial year that you're looking at right now. So if you imagine you're starting with financial year 2025, you're looking at what is the situation, what is the contracting model, what is the IP model of the group as it is right now. In other words, which entities actually make sales to customers, which entities purchase from third-party suppliers, which entities holds IP, what different teams are there in the entities, and reconfirm your understanding in the form of a clear matrix, which should just look like a table with a numbered list of transactions showing the supplier, the recipient, the nature of the transaction, the pricing model, and so on. So that's the starting point. The second step is to just carry out a quick audit of what existing agreements you have in place. And that may be as simple as collecting up all your agreements, putting them in a SharePoint folder and doing a list, and then actually checking those agreements one by one by reference to your matrix and say, do they actually tell the same story, both as regards to the nature of the transaction and the pricing of the transaction? Third step is to identify your key stakeholders. So that means on a risk-based perspective, on a proportionality perspective, what do you actually care about, or what would you care about if it went wrong? And that means making sure that the right people have a seat at the table, including regulatory, withholding tax, VAT, transfer pricing, finance, and legal. So just like any project, it's important to have the right people at the table. Step number 4 is to create an updated matrix. So sometimes following that internal due diligence, you actually need to update and refine your matrix of intercompany transactions. And based on that, you can actually create a streamlined portfolio of intercompany agreements. And when I say streamlined, very often the case that you've got multiple transactions within the same group. Let's say you have a parent company that is providing central support services to multiple service recipients. So you're going to want to document those transactions on a similar basis. In many cases, it may be appropriate to use a single multi-party agreement, because then you can actually demonstrate to tax authorities, hey, we've thought about our matrix of transactions, we've carried out our legal analysis, transfer pricing analysis, and we're documenting them in a consistent. The next step is to assign responsibility for the ongoing management of intercompany agreements. So this is something where large groups like Coca-Cola and JP Morgan have fallen down, which is they may have put in place agreements at some point in the past, but clearly they've taken their eye off the ball and they've not assigned a clear internal responsibility as to who will keep the agreements updated going forward. There's a classic question about, well, where should that ownership sit? Should it be with tax? Should it be with legal? Short answer is it doesn't matter as long as it's clear. But generally speaking, for non-regulated groups, it's usually the tax team that is ultimately responsible for maintaining transfer pricing, tax compliance agreements, because tax is often the biggest risk involved there. So that doesn't mean that they have to be doing the work. It's just that they are accountable for making sure that the work happens. Whereas for regulated groups, especially financial services, it's often the regulatory and compliance or legal team, which is ultimately responsible for maintaining those agreements, but needs to make sure that the needs of the tax teams or needs of transfer pricing, withholding tax, VAT are taken into account as a critical stakeholder there. And then the final thing is it's really to view agreements and align transfer pricing documentation as a readiness tool. So this is about how you maximize the value of your group when it comes to due diligence for investors, for exit, for investor relations, and so on. So some of the things that affect the timing of groups actually getting their act together. So clearly, if you're a group which has an eye to exits, demerger, fundraising, or IPO, then you will need to get your transactions in place sooner rather than later, because the earlier that you do that, the longer the track record that you have as a group for operating in a compliant way, and therefore the less likely it is that these issues are going to cause a problem in terms of valuation. Clearly, for acquisition and M&A integration, in other words, if your group is planning an acquisition of whatever nature, then the completion or the closing date of that acquisition is a key point in time. And in order to plan your integration of that entity, you're going to need to be able to start with a clear position as regards your own compliance rate rather than the existing intercompany transaction. So that tends to be a trigger for escalating or accelerating the work on intercompany. Obviously, if you've got anticipated tax audits coming up, then that's going to be a trigger to bring forward the work. High-risk countries and transactions. So some countries are rightly or wrongly regarded as higher risk from a transfer pricing and tax perspective, and therefore you're going to want to achieve a higher standard in terms of alignment of agreements with transfer pricing documentation. So countries in that category are probably Italy, because of the role of tax police in terms of tax enforcement and so on. And people generally don't want to be on the wrong side of that. India is well known for taking an aggressive position in terms of transfer pricing enforcement. Canada as well, Australia as well, and so on. And similarly, you're going to want to prioritize transactions that are most significant for your group. Similarly, in terms of looking further down this list, so filing deadlines for statutory accounts and corporation tax returns. So if you imagine a group which has a calendar year fiscal basis, and so here we are in the middle of 2025 right now, maybe the statutory accounts and corporation tax returns for 2024 are not yet finalized. What you don't want to do is to finalize those statutory accounts and corporation tax returns and then do the work on your transaction matrix and your agreements and find out that you've actually been premature in your filings and you need to backtrack and amend your accounts or provide for a liability or whatever. So generally speaking, you'll want to get your agreements, your transfer pricing analysis in place before you sign off on your entity accounts and your local corporation tax filings. I put on this list Pillar 2 compliance. So this only applies for obviously groups which are in the scope of Pillar 2, which is broadly the 750 million euros threshold. So before we finalize, just want to open up to any questions in case people did have any specific issues or concerns that they wanted to raise before we close up. So I can see a question just now. In cases where intercompany financing agreements were not formalized at the time of the transaction, should we prepare an agreement solely to reflect the historic arrangement, acknowledging that it is not currently in force? Again, really good question. Thank you. So obviously what we can't do is create a fraud. We can't sign an agreement now and date it or give it a date with a previous date. However, where you are faced with a situation where agreements are lacking, there's a gap in the agreements, or where the agreement in place is actually wrong, then the sooner you do something now, or the sooner you do something to rectify that, the better. And generally speaking, yes, if you can produce the evidence to say that what you're documenting now actually reflects the reality of the conduct of the parties, the entities, then it actually does create real value to sign and date an agreement now, but refer in the recitals to the fact that it has a historic effective date and that what is being done now is formalizing the arrangements which were undocumented in the past. So it is certainly better than nothing. It just needs to come with a health warning that clearly what we're doing now is not contemporaneous, and it will not be as robust as it would have been if it had been contemporaneous. I can see another question. How do you evaluate the IP related to operational know-how? Really good question, but unfortunately it would take a session of itself to talk about that. But the short answer is that it means that you may be looking at wider comparables, because there are a number of businesses where operational know-how, such as franchise type arrangements, where the operational know-how may be extremely valuable and it's reflected in the franchise fee, that reflects or that provides a third-party reference point. So the slightly longer answer is, unfortunately, you need to do the work in breaking down what are the different categories of IP, making sure that you're aligning your transfer pricing analysis of those individual categories of IP with the legal structuring of the transaction. So unfortunately, I don't have a quick answer to that question. So we've run out of time here. Just to give you some takeaways, I hope it's been useful for you in explaining the holistic view on intercompany agreements. If you do have any questions, please feel to reach out. As I mentioned, we will share the slides after the event. Really grateful for you joining. Particularly grateful for all of those of you who've raised questions. It really helps focus the presentation. So thank you very much, and I look forward to it next time. Thank you.